Hello and welcome to the Harwood Report for September 24th, 2018. I am Keith Harwood, the founder of Trade Academy. Let's do the disclosures. Whoops, I skipped through those, and then we will get to the content. So, reminder that all services and content are provided for educational and information purposes only and are not intended as legal or financial advice. Please take a moment to read through the rest of these disclosures as they are important and written by lawyers. All right, let's cover what we're going to cover. I want to focus on all of it again. Really, the stuff that's most interesting to me is oil because of what oil is doing. And then, of course, the indices because they're just kind of setting up some interesting formations again that, it feels like a little lather, rinse, repeat formation. And I'll talk through that when we get to the charts here. Before we do that, we always start with the fear and greed index. And the thing I just want to stick with here is that there's nothing that's showing a fear rating. Okay, yeah, the VIX probably is neutral, if not maybe a light greed. Stock price strength, this looks very neutral. This maybe shows some greed. How is this greed? I don't see it. This is right in the middle. That's neutral. This looks pretty neutral to me in the mid. This looks pretty neutral to me in the mid. So a lot of these things that are showing extreme greed are kind of false. And importantly, the thing that's showing the most extreme greed, where was this showing fear in, say, February? So as the market was running, this was at its highs. And as the market continues to firm, it's just going to its lows. But there's no real correlation to the market right now. So I don't necessarily consider this meaningful. And that's what I've been kind of harping on, I think, for a couple of weeks now. This means nothing. So this extreme greed input from here is overstating the greed of the marketplace. When we look at the actual stocks themselves, the S&P 500, it's doing what it does. You can see that ever since about July, the market's been in an uptrend. A little bit more convincingly, and it tests the 20-day moving average and then bounces off of it every time to make a new high. So here we tested the 20-day moving average, new high. Tested the 20-day moving average, and also looked a little bit really bad here on August 15th, but again, new high. Tested the 20-day moving average, up to a new high. Testing the 20-day moving average today. Maybe tomorrow is the ultimate low, quote-unquote, of this move. This is not much of a move, but we'll call it a move anyway, where we're dropping from the high of 294 down to the low here of 291. The other thing that, a little under 291, the other thing we have to keep in mind here is that SPY went ex-dividend on Friday, so there's $1.30 out of this market just off of the dividend. So really, it's almost like we're trading 292 with the previous high being 294. So we're really close to the highs, little pullback here, nothing major, continuing the uptrend. We see in the VIX that there's a bump today. A lot of times happens on Mondays just because of the weekend effect. And now it looks like that cash wants to weaken. So if that cash starts to weaken and the market starts to firm, let's say we get SPY back above 291, get a little closer to unchanged on the day, all of a sudden things change. What needs to happen for that to happen? Basically, people have to decide that everything going on with China and everything going on with Rosenstein right now mean nothing, and that the Fed this week is not going to do anything majorly problematic to the market. Do I expect that to happen? Absolutely do, personally. But if the market decides that something here from China, from Rosenstein, from some other input coming in the next couple of days matters, then the charts will dictate my move. Let's look at some of the other key sectors to see if there's something there. So we start with the Qs because I love the tech sector to give us a nice little indicator of how the market's working, and bam, it had a weak open, tested the 50-day moving average and runs. What did I say what happened with the SPY? It was testing the 20. Well, here, Qs test the 50, test the 50, test the 50, test the 50. There's a little more chop here. Just looks like it's setting up for the next run. SMH is a big component of that. Our semiconductors, the AMDs, the NVIDIAs, the Microns, all of these things that people talk about a lot on financial news networks because they have been some of the runners. Well, really, overall, the sector's been pretty sideways. A lot of that's probably driven by this whole China stuff because a lot of these guys use Chinese manufacturing. If this starts to get some money flow and actually can push through this 110 level, I think that's a really good sign for the tech sector. Qs could really run then. And of course, if they get weak again and push below this 101-ish level, basically sub $100, we've got problems. Right now, we're right in the middle. We're about $3 from that high level I'm looking for the breakout, and we're about $7 from the low level I'm looking to break out. So we're, on the upper end of the middle. If this can get a little bit more momentum flowing, and we see like the MACD looks a little bit bullish here, that sort of stuff could really give us some momentum into tech and get the market excited again. Because as tech runs, the market, people just get more excited. Like, people don't get excited about oil names going high to new all-time highs, or even retail. If Lululemon makes a new all-time high, people just don't get that excited. But when NVIDIA makes a new all-time high, or Apple, or Amazon, or something like that, that gets the market excited. So I want to kind of focus on tech being a potential driver of sentiment. We go to IWM, and we see here that this pullback is a little bit wonky here. Okay, so when IWM has had its pullbacks, I mean, frankly, since July, it's gone nowhere, but it's gotten just below the 50-day moving average and then kind of found bounces. But IWM's really kind of gone nowhere for the last 5 months. Now, one of the things I've been looking at as a proxy for the trade war is how IWM has performed relative to FXI. And if we look at FXI, it had gotten really weak. It looked like there was a lot of money maybe going into IWM and out of FXI during this period in June. And then since that July period, it's all both kind of been sideways. Today, we've actually got FXI and IWM weak. A little bit funky. Maybe it's people deciding that everything is just kind of, take a little bit of money off the table and everything. But, we got to watch FXI as well as tech to see if that trade rhetoric starts getting ignored by the market again. As of now, I'm thinking sideways for IWM continues. There's trades around that. I talk about that in the newsletter. So if you sign up for that free trial, you can get more information about how to make that kind of trade. Because IWM vol is not expensive. When I look at volatility here, we see, VIX level, that's the volatility of VIX. But if I go to IWM here, even with the bid up today to get it to, 12.5%, this is near the lows. The lowest we really get down to is about 11. So there are trades here around buying 11 vol, even with the market staying sideways. And I talk about the structure on that, as I said, if you go to the premium newsletter. Just a note here, tech vol is a little bit firmer, so you can see that that's been kind of bottoming out in the low 12s, and that's up in the 15s right now. So that's got a completely different structure for how to trade that bounce back market, retesting highs. And of course SPY, as I mentioned before, VIX is kind of getting low, but it had the bounce today, so this looks a little bit more like IWM, and that it's close to the lows. All right, so those are the kind of little nuances there for the trading tool set. So I use that toolkit to try to find the best leverage for my thesis once I've formed this technical setup. Speaking of which, let's go to TLT. So TLT is bottoming out here right now. It's consolidating at the lows. It may take another day, it may take another week, it may take another month. I doubt it takes another month. We just don't seem to do that for too long. We did, yes, in February, March, but a lot of times when we get these big move downs, consolidate for a few days and then start to run. We've got a Fed meeting on Wednesday, or announcement on Wednesday. They're going to raise rates. It's almost a slam dunk home. Like, I can't imagine a scenario where they don't, barring some sort of major, war basically starting in the next 48 hours. What I expect to see, frankly, at this point, given where TLT is and where positioning is in treasuries, is move right back to here. Right back to the middle of the range, up to 120. So how do we play a move to 120 over the course of, say, 3 weeks, 2-3 weeks? Well, options are a great way to get some leverage out of that. If the vol is cheap, you can just do it with long outrights. Vol is not necessarily cheap here. I could see vol getting back down to 8% on that move. Knowing that my expectation is to move to 120 with about a 3-week time frame and vol potentially dropping 1%, I can structure some stuff with call spreads, call butterflies, or call diagonals. And again, that's going to be in the premium newsletter. I'll give you the specifics of that trade there, of how I'm looking to structure the TLT trade. Let's move on to gold. Gold is interesting here. So you see it's gone nowhere for about a month. That coil is loading up. It wants to move, right? When we coil, we want to move. It can go for longer periods. IWM's had a longer coil than this. We had a period here of about 3 months where it really coiled. Here, we're only about a month in. It may happen now. It may happen in a week. It may happen in a month. I'm not actually sure on this. So I'd say, while TLT I think could happen sooner, gold may take longer. What I want to see happen is dollar yen break out. If dollar yen breaks out here above 113 and starts pressing and people start talking about 114 and maybe even getting through this high here of 114.74, I think people get really concerned with why bother owning gold. We see DXY on the whole has been firm. It's pulled back a little bit. Frankly, for the dollar yen to break out, we may need to see overall money flow into the dollar. But if we see this and we see the dollar index get back to 96 and dollar yen push 114, gold could be up for another major leg lower. Remember, one of the things that people talk about that I can't chart on here is the gold-silver ratio, and silver is basically as cheap as it's been to gold in a long, long time. I don't know the total number of days, so I'm not going to try to quote it. And you can see that silver had a bigger washout here recently, and it's kind of turning around. Maybe it's a little bit bullish relative to gold, or maybe it's just that gold had a sitting bid below the market because of the fact that oil's rallying, so people are putting money into commodities, and one of the ones they choose is usually gold. They don't always choose silver immediately. They get into silver when they get excited about precious metals, not when they're just putting an allocation to all commodities. And then if that allocation to commodities starts to dissipate, or people start to just focus on the oil story or focus on a new sector of commodities, such as the ags or natural gas or cattle or something like that, that could be the washout that gold catches up to the move in silver. So something to be watching for here is that gold washout potential. The thing I'm thinking right now, though, is that gold probably doesn't wash out this week. We would need to really start to press below 112.5 to start really making people worried about that washout, because the previous low there is close to 111. So we need to get at least below some of these recent lows to start getting the washout potential positioned. Finally, I mentioned oil. Let's just look at USO first. I mean, that's a new high. Brent is solidly above $80 now. WTI is solidly above 70. I've heard people talking today about $100 crude. Now, a lot of times when you hear people talking about those big moves to $100, that's getting close to the highs. That's the problem here, is that this is a double top, and people are bullish at the double top. That could be good. That could be bad. If we get the follow through, it means that there's money piled in buying some of these out of the money calls that could add to the move. Okay? So that could add pressure on the short if they're short calls. Just keep that in mind as we go to XLE, because in XLE, we're not at highs. We got $3 to just play catch up there. Or the one I really like is OIH. So we got $4 to play catch up there in a $25 stock. So we're talking about almost 15% move, or around a 15% move just to get back to the previous highs. And then if I look at the oil sector, we can start with XLE here. Vol doesn't get a lot cheaper than this in XLE. Vol can get a little cheaper, but not much cheaper in OIH. So if we've got this leverage move potential just to play catch up to the USO price to get people to start getting excited about these oil companies, because for some reason they're not excited about the oil companies at these prices. Maybe that's the new market leader. Maybe we have to get through an earnings cycle of positivity. We've got one of the big boys is starting to get some positive flow. I'll show you right now, and that's ExxonMobil. ExxonMobil had some bad earnings a couple times. And look at this. That guy is starting to get moving. So maybe some of the big oil names get their money flow. And then people start realizing, got to go to the small guys too. And that's where OIH can really come into play, because a lot of those guys got destroyed off of this oil move. So something to play around with here. I think there's a potential for a mega move in the oil names. I've been looking for some of these potential moves here historically in the past. And I think this is getting close to that next setup for that big move up. Maybe like we did here or here at the end of last year, and then in the middle of this year. So stuff to look at here is definitely going to, I think these are definitely going to be moves to watch. And that's probably the most exciting sector of all of them. So, I talked a little bit about it already. The Harwood Report is a premium product, but you can get the first week for free. If you sign up now, you take a 1-week trial, you see what you think. If you like it, it'll automatically renew and start you going on the monthly at $49 a month. If you don't like it, you just cancel. No harm, no foul, but I think you're going to find some value, because even one good trade idea out of it that sparks your interest and starts getting you thinking about how you want to play these markets can certainly offset any monthly fees. And I talk a lot in that about how I'm structuring my trade theses, how I would potentially trade these myself. And then we'll give you guys another update on Wednesdays about how these markets are transitioning midweek. So this Wednesday, we've got the Fed. I'll talk about how that has impacted, bond yields, gold, silver, and all the other stuff going on in the market, because all of that is correlated. The way the dollar moves impacts all of these other things. So we'll get a recap on the Fed and then move forward into next week. So go to tradeacademy.co/Harwood Report to sign up for that free week trial. Take a look, see what you think. And if you want to contact me, you can always email me, keith@tradeacademy.co. All right, folks, have a great afternoon, and we'll talk to you soon.